money is energy. You can't separate them.
Well, howdy, folks, and welcome to the Daily Coin. My name is Rory, and I have on the line Mr. Steve St Angelo from SRSrocco Report.com. How you doing today, Steve?
Rory, we're doing good here. It's a beautiful day, and I'm looking forward to a lot of things to talk about. So I think we'll have a nice interview.
I think so too. And I just so you know, I was introduced to your work through TF Metals, and that was back in the old days when he had just the old site on the WordPress, and I was introduced to your work. And then when he moved over to the new site with the community, that's when I really started paying attention, and people were kind of egging you on and saying you need to start your own website. And then I followed you right over to your own website. So I've been following your work for a long time, and being involved with SGT Report, that helped me to stay really connected with everything that you're doing. And so I just want to tell you how much I appreciate the effort that you've put forth. It's been awesome watching you grow and develop and build this incredible SRSrocco Report, because it is vital for our audience to understand the way that you are able to connect energy to the mining, to the actual finished product, and what's actually in everybody's vault. So I just wanted to sing your praises there for a minute, because I really appreciate all that you do. But I wanted to jump into this, one of your latest articles, and this one was published on April the 20th, and it's the 2014 full year results. Top primary silver miners lost $1.9 billion with a B. And that headline alone is enough to get anybody's attention. And I was reviewing this chart of the top 12 primary silver miners, and you are comparing 2013 to 2014, and you have everything broken down very nice and neat. And the thing that really caught my attention was the fact that there's a $288 million production cost change from 2013 to 2014. Is that strictly related to energy, or what costs are built into that?
Well, there's several. Part of it might be energy, but as you notice in that chart, silver production grew from almost 93 million ounces in 2013 to 118. So it grew 25 million ounces. And most of that, 20 million of that, was the new Tahoe Resources Escobal mine in Guatemala. They started at the end of 2013, but they had a full year in 2014. So they're producing about 20 million ounces a year. They're actually the lowest cost producer that I know of. And so they had, I think it was 127 million in costs to bring on that 20 million ounces. So we can add that in. And then, interestingly, some of the mines like Silver Standard, several of them added some primary gold mines. I don't know why they did that, but they did. And so there's a gold mine, even though it might be a small gold mine, it has some significant production costs. And then we had about 5 million ounces of increase for the extra 5 million ounces. So the costs that were attributed to producing 5 million ounces more, and those were from like First Majestic, Fortuna. So I would say some of it was energy related, and the rest of it was what I just explained. So yeah, it's interesting looking at the chart, and I definitely recommend people going to the site and looking at it, because I don't think anybody is looking at the industry as a whole. And when you add all the information together, you get to see a different perspective than looking at an individual mining company, and that's why I started doing that. So the most standout data that I found really fascinating was that they produced 25 million ounces or more of silver, but the total net revenue for the group only increased from 3.1 billion to 3.4 billion. And what I haven't mentioned is that the byproduct revenue increased almost 400 million. That's the byproduct revenue and gold. So the increase in the total revenue wasn't from silver. It was all from the byproduct revenue and the gold mining. And so actually silver fell. That I found a very interesting statistic. So basically the miners in 2014, the top 12 that I look at, they produced another 25 million of silver production, and they still lost money, even though they brought costs down. And if you look, the break even for 2013 was about 24, and now it's 19. So they were able to drop costs, and that was from cutting back on exploration, cutting back on a lot of things. Energy costs fell, so they were able to shave $5 off of their break even. But the realized price was even lower. It was $18.85 for the group. So they lost about 38 cents an ounce for each ounce that they produced.
So if I understand correctly, if they didn't have the byproduct, they would have lost a lot more money.
Yeah, and you see,
and not just the 38 cents an ounce. I mean, it would have been, because if you take out that $300 million in increased revenue. I mean, if you subtract that out, right? Or am I headed down the wrong path here? But if you take that out, they're 23% lower.
Yeah, what CPM Group, Jeff Christian, our buddy over there at CPM Group,
our pal.
Our pal. He comes out with the Silver Yearbook, CPM Silver Yearbook, and I mentioned this in the article. Kind of brag. We haven't seen the 2015 report. The 2014 report. He said that according to their estimates, that the cash cost for the primary silver mining industry fell from above $10 in 2012 to like $9.60 something cents in 2013. So, according to the typical, let's say, naive investor, not unsophisticated, just looks at things quite simply, doesn't get too involved, they think that it's costing the primary silver mining industry less than $10 to produce silver. And that's cash cost accounting. And my thing is, cash cost accounting is totally worthless. First of all, it's not a generally accepted accounting principle, which means when you figure cash cost, the company deducts the byproduct credits. Well, if we look at the chart, 1.5 billion was byproduct credits and some primary gold mining. So I take out 200 million. So about 1.3 billion was byproduct gold, lead, zinc, and copper production, which came as a byproduct of silver. So they're saying that the cash cost for the group is about $10 because they're deducting 1.3 billion in byproduct metal sales. You see, a credit is a freebie. If you have a credit, you go to a store, they say you've got a credit for your account, well, then you can buy something. You've got money to buy it free, basically.
Right.
Well, it's not the same thing with the mining industry. The miners need their byproduct revenue to fortify their balance sheet because, like I just mentioned, that their estimated break-even's right around 19. That's $9 above above the $10 cash cost.
Almost double.
Yeah, and so this idea of cash cost accounting is totally worthless. It's meaningless, and I don't know why Jeff Christian continues to use this metric because it confuses investors to understand the real cost of mining silver.
Well, I mean, that's part of his job is to confuse investors. I mean, I hate to sound harsh or rude about it, but that's just the fact of the matter. I mean, and you may disagree with what I'm about to say, but he works for a criminal organization, and their job is to line up the people, strip them of their money, and send them on their way. And that's part of his job is to do that. Otherwise, why would he put something out that doesn't fit with generally accepted accounting principles. I mean, that in itself says that I don't really care about the rules.
Well, it's interesting. GFMS, and I actually like their data better. GFMS, they produce the World Gold and Silver Surveys.
Yes.
Now, is some of the information incomplete? Is some of it massaged? Is some of it manipulated? Sure, it could be.
Yes.
But it's the best data we could go by. But what they have done, there's a new thing called the all-in sustaining cost, and that's actually a lot better than just the cash cost. And they look at that more than CPM Group. And another thing that CPM Group still does is they look at silver, the market, at net investment demand. So if we have supply, then we take out industrial demand, we take out photography, we take out silverware. What's left over is investment. And he says it's like a net investment. Well, GFMS no longer does that. They used to up till 2013. Now they actually have a physical supply deficit or surplus.
Okay.
Well, the CPM Group hasn't changed it, and they're still doing it. And that's a very inefficient, inaccurate way to show what's actually happening in investment, because investment has been the biggest growing sector in the silver market since 2008.
Now, I want to ask you about these 12 primary miners that you are using in this research. Does all of that silver stay home? Does all of that go to the mint and to various, private mints, or to the U.S. Mint? Where is that silver going? And is some of it being shipped out to India and China and Russia?
Well, each one, some companies kind of state where the silver is being sold, where it's being shipped, where it's being used. Like, for instance, Hecla, a lot of their silver goes overseas.
Okay.
And the United States is probably one of the largest importers of silver. We're importing something close to 5,000 metric tons, and the world production is 26,000. So it's like a fifth of all silver we're importing.
Wow.
A lot of the silver, especially from Mexico and in South America, a lot of that silver is being exported to either Asia, the United States, and Canada. Those tend to be, and some of it's going to Europe, but that's where most of it's going. A lot of the silver that's produced in South America and Mexico is exported. They don't consume much of their own silver. So a lot of it is exported, and some of it goes to the mints, but most of it is used in industry.
Okay, so it's winding up in cell phones and computers and televisions.
Right.
Okay.
Right.
All right. Because the reason that I'm asking is because I want to ask you, as I ask everybody. China, as you are well aware, is gobbling up with both hands every scrap of gold that they can get their hands on. It appears that Russia has now joined in the fold, and India has long, taking as much gold off the market as possible, as much as possible. Right. India's most recent numbers said that they imported over 100 tons. Where is all of this coming from? Where is all this gold coming from? Because if you do an annualized rate on 100 tons a month, that's about 1,000 tons from this point forward, or 900 tons?
Just for India.
Just for India, and there's only 2,400 tons mined.
Actually, from what I understand, and they've been increasing. I think the mine supply now, according to GFMS, for 2014 is like 33,200 metric tons.
Okay.
So not a lot more, but that's about the figure. 3,200, 3,300, 97 million ounces were produced in 2014, according to the official data. But we also have recycled supply.
Right.
And that comes on. but that's been falling significantly, and that's about 1,000 metric tons. So you add those up, that's about 4,000 plus or minus metric tons, more than we think. But it's, we don't know what China is absorbing, the official government. We have no idea if they're taking, Jim Willey, I think, says that they're probably acquiring thousands of tons a year, and they've maybe even acquired a lot more in the past. So I believe a lot of this gold has been stripped from from these allocated accounts, unallocated accounts. It's been stripped. I think most of the gold is being consumed, mine supply and scrap. But then if there's a deficit, which we don't even know about, I don't even think the official statements, the official reports out there by GFMS, I don't even think they have correct data on this. Whatever is a deficit is being met by gold coming from the New York Fed or gold coming from stocks that are being depleted, and the people who supposedly own that gold don't even know it.
There you have it. They don't even know it.
No, I don't believe. And the thing is, we won't know until China finally comes out and says this is how much gold we have, and then we'll have a good idea how much gold.
The Shanghai Gold Exchange, they're moving somewhere around 40 tons on average, around between 40 and 50 tons of gold per week, and they have been for several years. Now, if you just take, we'll be conservative and we'll use 30 tons, okay, times 52, that's 1,500 tons. Okay, so that's 1,500 tons. Now, by your own word, you just said about 4,000 tons a year. India's moving about 1,000 tons, so that's 2,500 tons. Russia last month took 80 tons. So if you use 20 tons a week times 50, that's another 1,000 tons. So now we're at 3,500 tons. And that's just 3 countries. That only leaves 500 tons out of 4,000. We'll say 4,200. So it's 700 tons of gold.
For the rest of the world.
For the rest of the world.
Right. No, there's a lot. I would say we're suffering. We've been suffering an annual deficit for years. But we don't know what that deficit is, because we do know that when the price of gold and silver moved up to 2011 and peaked, both of those metals peaked in 2011. The price silver was 50 and gold 1,900. Well, that couldn't stand. People say, well, it was a spike, it was a parabolic blow off. Well, when you've got 105 trillion in global conventional paper assets, that's a blow off. That's a Ponzi scheme. So you can't compare a very small gold and a minute silver market to what is the largest Ponzi scheme in the world. And I know we might get to this next article, but now that we're talking about this gold investment and demand, I wrote about this, that when 2008 hit, Americans started to wake up, or more Americans did, and our investment of gold increased significantly. And but we were consuming a lot of jewelry. Americans were buying a lot of jewelry from the 1990s to about 2005. They were buying, because the price of gold was $400 an ounce. We were buying massive amounts of jewelry. I think some years 12 million ounces worth of gold jewelry. Well, as the price of gold got expensive, what did Americans do? They cut back on their jewelry expenditures. And I think the lowest it got, from 350 to 380 metric tons in the 1990s, early 2000, it was like 120 in 2011. It fell that much, almost a third. But investment demand picked up. Well, here's what's amazing about Americans. The price of gold fell again in 2014. As we're talking about, Asia, India, China, all these countries were buying record amounts of gold investment. Well, what did Americans do? They increased their jewelry buying once again, and gold investment fell to 47 metric tons. And I think the high was 120 one year in 2000, between 2010 and 2012. So there we go. Americans will buy gold jewelry if it's cheap enough for, wearing it for adornment purposes, but they won't take advantage of a low price like the rest of the world is doing. Instead of buying gold investment, they're buying highly marked up gold jewelry.
Yes. Yeah, I actually like buying gold jewelry on the secondary market in pawn shops and junk stores and flea markets and that kind of thing, because I can typically get it at, fairly close to spot, because those guys, that's what they, people that are buying jewelry at the We Buy Gold places, they're paying you about 40 to 50% of what spot is. So if gold is 1,200, they're starting around 600 for their price, and that's what they offer you. So if you've got 3 grams of gold in a ring, you're going to get about $50 to $75. So I can go in and get that ring from them for $150. I'm right at spot, and everybody's happy. They've made a massive profit, and I've gotten a nice piece of jewelry that I can do with whatever I want, and it's right at, like I said, right at spot price. So I encourage all of these Americans to go out and buy gold jewelry and then sell it to the pawn shops.
Well, that's what they did. This is what's so funny. When the price of gold was low, when it was $300-400 an ounce during the late 1990s and early 2000s, the Americans loaded up on a lot of gold. We loaded up on lots of gold. Well, what did they do in 2008-9 when the conditions got rough and it was hard to make? They were losing their jobs. They pawned billions of dollars worth of gold jewelry.
Yes.
They didn't hold on to it. Now, I would imagine the folks in India did not pawn any gold in 2008, 9, and 10. I would imagine they added to their they look at gold differently.
Yes,
even though it might be adornment, it's still it's like their net worth.
Yes.
So they look at it as an investment. We look at it as something that looked nice to go buy that Starbucks $5 cup of coffee.
Right. That's exactly it. No, it is. It's, even though it is jewelry in the Middle East and in India and all over Asia, that's the way that a lot of people have gold, is in jewelry. But it is, like you said, it's much different mindset, in that this is my family's wealth. This is me showing you that I have wealth, that my family is wealthy. Whereas, like you said, it's nothing but, this week's bling bling that they're showing as they go get their $5 cup of Starbucks here in America.
Yeah, and we'll get into this, but it's a whole different mindset somehow. The Western, U.S., Canadian, UK, the Western European investors, and I would say more U.S. and
Yes.
Canadian, but we think wealth is something. It's a digit in an account, or it's a paper asset. That's what we perceive as wealth. So gold is kind of like a joke. It's something that CNBC and Fox. It's a joke. It's a barbarous relic. It's interesting. They say it's a barbarous relic. Why would we need gold anymore? Well, bread. The Romans, a lot of their cities lived on bread. Well, you go to any grocery store or any huge chain, you're going to find a huge aisle of bread. Bread's still around. You'd think we would do something better than eat bread, but we're still eating bread after 2,000 years. So and brooms too. They used brooms during the Roman Empire. We use brooms today. Nothing, So to say gold is a barbarous relic just because it's old, it has no meaning at all. And so certain countries understand that's real wealth. We've been brainwashed to believe digits and paper assets are wealth.
Yes, digits on a screen. And yeah, let's stay right there, because you wrote this other article, the U.S. gold market, completely insane, in which you're looking at comparing what you and I have just been discussing, which is the gold as an investment versus the jewelry. And you really go into some really great detail regarding the differences. I want to read this passage, and it says, from 2008 to 2014, gold jewelry demand fell considerably to 992 metric tons, while gold investment more than doubled to 545 metric tons. Thus, retail gold investment over this 8-year time period was 35% of these two markets, while jewelry declined to 65%. In 2010, retail gold investment peaked at 45% of the total as jewelry fell to 55%. And I know you were just giving some of those rough numbers, but I wanted to kind of put a pinpoint on that, because I think that is huge, because if we have that much gold that went into a vault, probably never to see the light of day, or most of it.
Correct, and a lot of that was the official coins, like the gold eagles and the gold buffaloes. We were selling a lot of those in over 1 million in 2008 and 9, 10, 11. And so, yeah, that's interesting. We see that peak. Americans, 45% of the gold investment and jewelry market, which is those are basically the majority, even though there's some gold industry demand. But those are the big two. And so from 1999 to 2007, investment demand was 7%, where jewelry was 93%. So it just shows you how much gold jewelry that Americans were buying. And then after 2008 to 2014, it changed. And we had a huge increase in investment demand. But again, I found this interesting. It's an interesting correlation. When the price of oil spiked to $148 back in 2008, Americans started buying smaller cars. And we can see it in the EIA data. Our efficiency, our economy, our mileage economy improved in 2008 and in 2009. Well, as the situation got better and the price of oil, even though it declined, but then it went back up. It was, I think, in 2010, it was in the 70s to 90s range. Well, what did Americans start doing? They started buying SUVs and big trucks again. And so the efficiency fell. And this is the same thing with Americans with the gold. As soon as they thought that the Fed had the situation back under control, all right, we're building houses again to nowhere. We're doing all this worthless activity to promote economic growth that's not sustainable based on the Fed printing money. Well, Americans now are buying more gold jewelry instead of investment. I find that such an interesting correlation, how we have such a short time frame, or we live like a gnat. We have such a short mind span or time span. We don't think in longer terms as the Asians and Chinese do. We look at things in weeks, quarters, and a year.
And that's it. Now, and speaking of years, how do you see the oil playing out? I know that the prices are suppressed right now. How do you see that playing out over the next, say, 5 years? I mean, where do you see it going from this point forward?
It depends on price. And I've said this in several articles and in several interviews, that the world could not afford expensive shale or tar sands if the market wasn't propped up by the Fed and central banks. By pushing trillions of dollars worth of monetary QE and liquidity into the market, as well as lowering the interest rate to zero, that allowed us to afford, the U.S. Americans to afford expensive oil. But I believe if the market reset, banks were crashed, banks went under, we had bankruptcies, and then we had a severe depression like we did in the 1930s, shale oil would not come on the picture, not much of it. Because I'm looking at a chart right now done by Art Berman, who I think is one of the most excellent energy analysts, and the total debt of these top shale oil companies increased from $83 billion to $90 billion in 2014. And their free cash flow, that's taking their operating cash after all expenses are paid, and then minusing out the capital, their free cash flow increased from $2.9 billion, a negative $2.9 billion, to a negative $10.4 billion in 2014. So they were still getting a pretty good price of oil back in 2014 until the middle of the year. And can you imagine how bad it's going to be now? So what Art Berman believes is going to happen, we're going to see between 500 and 600,000 barrels a day of oil taken off the shale market, shale oil industry by June, July. And
really?
We're already seeing that. It's already happening. But I think by summer, the U.S. market will realize how bad the situation is. I'm looking at another chart done by Gene Lahira, and he has the North Dakota back in oil production peaking sometime this year. And it may have already peaked because of low oil prices. And, it may have peaked in 2014 in December. That might be it. But he has it peaking about 2015. And do you know by 2025, 10 years, it's down to about 100,000 barrels.
Wow.
And Eagle Ford will be the same way. That will decline significantly as well. And if you look at these shale oil fields and gas fields enough, Roy, there's about a 7-year time limit where they start production and then they peak. The Barnett, which was the big shale gas field, the first one that came online in 2005, it peaked right before 2012. The Haynesville, which is another gas field in Louisiana, that came on in 2005. And matter of fact, it was producing the most shale gas in the United States. That peaked right at 2012. Well, when did the Bakken and Eagle Ford come on? They came on right around 2008. And you add 7 years, and you got 2015. And I don't care how much higher the price of oil goes, these fields will peak. You can only drill so many wells. So I think by 2020, the question you asked me is, what will the situation look like for the U.S.? I believe anybody living and breathing in 2020, any American will realize we have peaked in oil production, and it's never going to come back. We're never going to have another jolt from some other field or somewhere, another kind of oil production. So what will that do? Well, by 2020, we may be down to, instead of producing 9 million barrels, we may be down to 7 million barrels. And then the rest of the world, see, here's what's interesting. If we take out the U.S. and Canada, the rest of the world, oil production has been declining for the last 3-4 years. That's Saudi Arabia, that's the Middle East, that's Africa, that's Europe, that's South America. Production as a group, if you remove the U.S. and Canada, has been falling. So once the U.S. production starts to fall, and it will fall fast because it's shale oil is a very high decline rate. So if you don't keep producing wells or drilling wells as fast as you can, the production will start to decline. And it's going to decline because our drilling rig count in the U.S. was 1,600 at the peak in 2014. It's now at 800. So we have cut it in half, Rory.
Wow.
We will see, I think, severe trouble in the U.S. shale oil industry as well as the gas industry. I think we're going to see serious bankruptcies. Now, why is that important? Because, as I've said before, energy and precious metals go hand in hand. Energy drives the economy, and a finance is supposed to steer it. Well, it's steering us over the cliff. Well, a good accountant for our finance has been gold and silver for thousands of years. But now we have all these paper assets out there. And you see the difference between gold and silver. When you own an ounce of gold or an ounce of silver, it has economic energy or energy value that's stored in it.
Yes.
It's like a battery. It already has the energy stored in it. Well, if you have a $200,000 IRA or retirement account, that's not a store of value. That's an energy IOU. That we have to burn energy in the future, and not only the same amount, we have to burn even more for that system to work, for you to get your money back as a retirement account. Well, when the world finally starts to peak, and we could see a significant fall in production, by 2020, 2025, it makes all those paper assets, the valuations, it makes them actually implode. So that's why I think the precious metals, and I've been going on for a long time here, that's why I see precious metals as the best quality stores of value, because most paper assets and even physical assets will continue to decline in a peak oil environment.
You mentioned the fields in Louisiana and I believe Oklahoma.
In Texas.
In Texas, okay. And those two peaked after 7 years. Are they still producing, or are they beginning to shut down? I know you said that we went from 1,600 rigs down to 800 rigs. Are those fields still producing at this point? And if so, are they profitable? I mean, how much longer do you keep going if you're losing money?
Well, Art Berman did a 1.5-hour presentation last month for the Houston Geological Society. And he says, and I agree with him, that the U.S. shale gas industry is a commercial failure. That industry needs between $7 and $8 for natural gas to be profitable, to be sustainable. We're getting what, $2 to $3. So what's happened is that whole industry has added a lot of debt. They needed additional financing because they didn't make enough money from their operations to fund the new drilling. And so, oh gosh, now that you asked me that question, let me just tell you this. Do you know in 2014, and this is all liquids, the U.S. drilled 35,700 wells compared to Russia's 8,600, and get this, Saudi Arabia 399.
Wow.
So now this is total production. This is not oil. We're still the third largest oil producer. We're not the top. But, Saudi Arabia produced 11.4 million barrels a day. Russia was 10.9, and we were 11.7. But we produced a lot of other stuff, a lot of natural gas liquids, which isn't oil. And a lot of condensate. That's actually like gasoline. But that just goes to show you, we drilled almost 36,000 wells compared to Russia's 8,000 and Saudi Arabia's 399. So we're doing a lot of work to get this oil out of the ground and natural gas. So the problem is the Barnett. The drilling rigs have fallen considerably in the Barnett. There's only a few. Haynesville is the same way. They're still producing. They still have production, but it continues to decline each month. And we have to remember, a shale gas field, either oil or gas, has a sweet spot, and where you make your money is in that sweet spot. Well, as you move outside the sweet spot, the profitability or the economics really starts to decline. So all those sweet spots have been exploited. And now the Barnett is, I believe, they're down like 40 to 50% of their production is down that much. Haynesville is down, I think, about 30%. Now the mighty Joe is the Marcellus up in Pennsylvania, part of West Virginia. And that's still increasing production. They're still increasing production there. But that will likely peak in a year or two, and then that's going to be it too. And lastly, Art Berman, going by the actual reserves, shale gas reserves, and these are official reserves. We've got 8 years worth of shale gas left, and then it's gone. That's it. 8 years worth of total consumption, and we're done. But all that might not be commercial. That's just reserves. And in shale oil reserves, we have 3 years left at current consumption. And that's like about 19 million barrels a day. But that's not going to last that long.
No.
So this is the question that no one asks. How do you run New York, Dallas, Texas, Chicago, LA on 70% or 50% of the energy that we used to? It doesn't work. What does it do to the price of real estate? What does it do to businesses, the price of businesses? These big box stores like Walmart, now we're starting to hear some are shutting down. They're blaming plumbing. How do you run Walmart when we're down to 70 or 50% of the energy? So again, the precious metals the value of precious metals will increase in that situation. I think the levels they could reach are unbelievable, because really there won't be assets that are gaining in value. There won't be many. And I think the liquid assets are going to be physical gold and silver.
I would have to agree. And I want to ask you, and if you're not comfortable discussing this or answering, I certainly understand and respect that. But there's been a lot of talk recently, well, the last 6 or 8 months, about 2015, and there being some really nasty things to happen economically, to our economy, to our finances, to everything. And do you see anything like that happening in the second half of this year, as far as things just kind of falling apart? I mean, based on your research, because you look at things quite a bit differently than most everybody else, or most people that I speak with, in that you look at what fuels everything, and that's the actual energy. I mean, do you see some kind of, not Armageddon, but some kind of severe bump in the road coming up within the next few months, or do you look at things in that kind of terms at all?
Well, we have to, this idea of the Shemitah and the 7-year cycle and these longer 49-year cycles. I mean, they make sense. We can't discredit them. Now, that being said, are the Fed and the central banks, are the elite able to postpone this? I mean, I was in the big city, and my wife and I, we sold our business and we moved out to a small ranching community because in 2007, I knew what was coming.
Yeah.
And when it came, I wasn't shocked. I was surprised at how it unfolded. It was like, to understand it and to see it happen, and to see Paulson and Bush and Bernanke get up and have to get up in front of and calm people's nerves as Lehman Brothers and Bear Stearns were going down. I mean, that was a very real situation. And we could have had a collapse of the whole system. It was that bad. So I knew it was going to happen. What I didn't realize is you and many of us in the industry, in the precious metal community, didn't realize how long they could paper this over. And again, you need the energy to paper it over. So we were able to bring on this energy to paper it over. However, I do believe that we will probably see, there's a high chance, a high likely ability that we will have some kind of dislocation in the third quarter, the second part of 2015. And I think this will actually stem from the shale oil and gas industry. I think, as some commentators have mentioned, that it's twice as much money to prop up the shale energy industry that was to prop up the subprime housing market. So that can't go on forever. And I think as the price of oil has fallen, it's putting now a lot more stress on that system. So I think we could see a dislocation. We could see a huge market crash. And how things unfold, I don't know. I don't.
Yeah.
Do you think they have any bullets left in that gun to keep things going after the crash finally hits?
No, there's nothing. I mean, right now, I'm looking at acquiring yuans or Russian rubles. I mean, because the dollar, I don't see how the Federal Reserve, or the European Central Bank, the ECB, I don't see how either one of those entities can continue this nightmare. If there is some derivatives, or something in the very, very opaque over the counter market, if something breaks back there, then it is, and is it going to be Greece? I mean, I don't know. I mean, I really don't know. I mean, them leaving the euro, I mean, they were talking about a 50% haircut this morning on some of their bonds, I believe, and it's like, what's going to be triggered, and do they have any bullets? No, they don't. They don't have any bullets.
Yeah,
except to
and
steal people's money, except
that
to go into their accounts and to take all the digits off of the individual screens and say, well, you had 200,000 digits on your screen. Now you have 50,000 digits on your screen. Sorry.
no, I agree with you. And I guess the best way, this is maybe the best way for me to answer that question. I look at things more fundamental, I look at how things are going to unfold because, when we're not insects, we're humans, and we have these long lifespans. They're like we could be 75, 80 years old. So we live these long lives, and if we don't see something, our children will. And so uh, that's how I look at it. And I believe owning gold and silver, even though the paper price has fallen over the past several years, I look at it as investing in a retirement account. You
Yes.
do the same thing in a retirement account, and at least though, when you have gold and silver, you can actually trade it in and get something. If the retirement account implodes, you don't really have anything. And Bernie Madoff proved to us that Ponzi schemes are still taking place. But even though I believe the energy situation will force a disintegration of the United States into regions, that will happen. And the world will be a much different place once peak oil really starts to arrive and oil production declines. And it may come in fits and starts, but the system is so weak now that we can have a collapse, a derivative collapse that could happen tomorrow. So I don't see how they can postpone this thing. They may for another year or so, 2 years, but I don't see them postponing it past the end of the decade. As a matter of fact, I think things could fall apart a lot quicker. But even if they don't, Rory, Americans will be living a much different life by 2020.
I would agree with that wholeheartedly. That by 2020, there's going to be some major changes in this country, and we may not even recognize it from what it is today. So, but on that happy note, we've been speaking with Steve St Angelo from the SRSrocco Report. And Steve, I certainly appreciate all your time today. It's been a pleasure speaking with you, and I hope that we can do this again in the future.
Yeah, Rory, I've enjoyed my conversation with you, and I'd like to leave on one thing that I didn't get to, and maybe I spoke a little bit about it, but I like silver better than gold, even though gold is our king monetary metal. There's just a lot less silver, and it's more affordable. So when the system resets, I believe you will not be able to get silver. So people tell me, well, what if the elite can continue manipulating the price of gold and silver? Well, there's two ways to value silver. It's just-in-time supply chain mechanism and its cost. And that's what we're seeing right now. It's not the value of silver. It's how much is being consumed. So that's the way it's being valued now. But the future will be a store of value, how it's competing with the U.S. dollar, the U.S. Treasury, all the other bonds, as well as the $105 trillion in global conventional assets under management. Silver and gold are competing with all that stuff. And when the world realizes peak oil is here, that stuff loses value quickly. And so the idea then is, well, what do I get into? And you get into physical assets, especially gold and silver. That's when we will see the store of value of gold and silver finally being realized.
Yes.
It's not right now. It's still being priced as a commodity. How much is supplied by how much is consumed. We're going to see how it behaves as a true store of value. And when that happens, Rory, I'll tell you, it'll be amazing to see how high those values will go. People still don't get it. They don't get that point where silver right now, silver and gold are being valued as a commodity. How much is consumed and how much by supply and then consumption. So if we have a lot of consumption and there's more interest, then it goes up in price. But that's not its real value. And
right.
So people need to understand that. They really do.
Yes, and I would agree. And what I try to do is I try not to look at it as dollars. that I've got, that an ounce of silver cost me, $22, or that an ounce of gold cost me, $1,200 or whatever, and try to look at it as what will this purchase? What is the real value in this, and what has it historically been able to purchase? And Chris Duane's done a great job of putting it into perspective as far as, a tenth of an ounce of silver is 1 day of labor. And Mike Maloney has looked at it he's done a great job as well of comparing, gold to the stock market and to real estate. And so you have to look at it in those kind of terms. I mean, people were buying in the 30s, I believe, in Weimar, Germany, or in the 20s. They were buying, homes for an ounce of gold. Okay. Can you imagine buying a house today for 1 ounce of gold? Can you imagine doing that in 2021? Maybe.
I know, and I think that the where there's a lot of where I believe a lot of good analysis can be focused at is understanding what values, what items are going to be sought after.
Exactly.
I say the gold and silver because why would you invest? I work up here. I can't believe the amount of warehouses they're still building.
Yeah.
And I'm just surprised at. It's like people don't realize we're peaking. We're peaking in oil production. Why are we building more? Why are we widening the interstates? Why, maybe repairing a bridge might be wise, but why widen the interstate? And so I'm thinking, why are people doing this? And they don't see it. There's a disconnect. And so and here's a difference I see, even though gold and silver can buy today, $1,200 for a price of a gold, you can still buy a nice suit that you could buy, a nice toga and sandals during the Roman Empire. But the difference is the world we've siphoned all that wealth into paper funds, so we really don't know what the value of things are anymore.
Right.
And when we do get that crash, that's why I do see gold and silver as investments, because people have lost touch with what they're really worth, as well as what other things are worth, like farmland. And so,
everybody's been conditioned to price instead of value. And I can't remember who did it, but there was somebody did a great video on exactly that, on the differences between price and value. And there's a huge difference, and that's what we have been. And I'm speaking globally. People have been conditioned to price as opposed to value, and what something actually is worth. And that's where I see one of the major breakdowns with the general public looking at gold and silver. And they don't see any value, but they see the price, and they see the price going down. They say, well, that's a Barbarous relic and the price is going down, so I don't want any part of that. That's not a good investment. And you can't eat gold. Well, you can't eat dollar bills either, and you can't eat digits on the screen. And neither one of them are going to do you any good, except unless you need to start a fire. I mean,
that's so correct. And I did want to mention, and maybe in a month or two you might offer me another interview, because I'm going to come out with 3 silver paid reports on the silver market and the industry, and they're very inexpensive. I mean, they're going to be priced between $50 and $30.
Okay.
Very, very inexpensive paid reports, and it's my way of trying to pay for some of my time. But the first one is going to be on a lot of my charts, silver charts, all updated, the best ones, and then I've added a lot of new ones. And
Cool.
So it's going to be on 5 areas of the silver industry and market, and I'll take a chart for each page, and then 3 or 4 paragraphs describing each one. That will be my first report. The second report is going to be on the silver market.
Okay.
And I think I told you this already, but there are some fascinating information going back in the 50s and 60s and now. I mean, it's fascinating what we really don't know and where we're at now. And where we're at now is just amazing with how much silver we have available. So I'm going to write that one is going to come out in a couple of months. And then
Okay.
the third one's going to be on the miners. But I did want people to realize that I think if they read that second report, David Morgan doesn't even know it. I spoke to him about it, and he didn't even know the data I was talking about. He was
Wow.
he was shocked, and
Wow.
he's really excited.
Okay, cool.
So this information, once someone looks at it from beginning to end, they're going to go, "Oh my God, we should be buying silver." And so that I really think so. I really think so. So. I would love to get that some people to understand I'm doing that. So if at some point in time we could talk about that, I could discuss some of the charts in the report, or I'd appreciate that, because not just because making money, but I think the information is groundbreaking.
Well, I mean, I would love to have you on once a month, Steve. So that's, as far as you coming back on, that's not an issue. I mean, we'll get you back on, and what I'll do is get you over on the Shadow of Truth, and we'll get Kranzler involved, and we'll just we'll just have we'll have us a real happy little round table with the three of us, and make something big happen, and that way you can really shine some light on some of this research that you're doing. And
I couldn't believe we suffered a 450 million ounce deficit in 1965.
wow,
That's even that just goes to show you. No, I think it was 1964. It was one of those 2 years, but the world suffered a 450 million ounce deficit. I mean, can you imagine? I think the production was like in the 200 million range back then. Now it's in the 800 million range, and so it was 4 times less. And our deficits? I think we had a deficit. Let me look right here. We had a deficit one year, according to GFMS. We had a deficit of 172, actual net deficit of 266 million ounces, and that was in 2008. And we produced in 2008 684 million ounces. Can you imagine 450 million ounces deficit in 1964? And where did the silver come from? The sugar daddy, the U.S. Treasury. That's where it came from.
Okay.
Yeah. Oh, it's an amazing story what's happening, and then you see what happened in the 60s and 70s, and then the price shot up into the late 70s, and then it died off. It had to die because it couldn't have continued, and then all that silver went into the private hands, all that coinage and all went into the private hands, and it became this unreported 2.5 billion ounce stock out there. Well, that's been drawn down to now less than 900 million. And you know where most of that is? In the ETFs.
Yeah.
We are on silver fumes.
Yes.
And people don't realize how much the fumes that we really are. So
that will be seen very soon. I think that
yes.
I really do.
Yes.
So.
Well, listen, I know you probably have to go, and I do appreciate your time.
Well,
all right. Thanks so much, and you have a good day.
Thank you. You too. Talk to you soon.
All right. Bye-bye.
Bye-bye.